All right. I'm going to give it a couple of minutes. People are probably going to drift in. So, in addition to the normal, trading the Friday closing behavior, and there's a lot of good stuff around that. The first and most important of which is never fade Friday strength. And we have some late Friday strength. So, you want to be careful fading this. You can get way off sides doing that. Anyway, I'm going to talk more about that and about some other things. I rearranged my screens a little bit for the purposes of this session too. I want to compare a couple of different intervals of wave volume just to give you guys a sense of that. You know what? If I'm going to do this with different colors, though, I need to change the color on here. So let's do the downswing color volume. Let's just make those white so we can see them. Okay, that solves that. I'll do the same thing over here. So white, thick white. Okay, cool. All right, as I said, we'll get started in a couple of minutes. I'm going to try to summarize some of the stuff I've talked about in the Chart to Dome, which was a premium class, and it's available right now as part of that January package that Lee posted about in the Facebook group and in the pit. If you don't know what I'm talking about, real quickly, in the pit, or it's on the website also, I think, but where was that? It was back here. Holiday market hours, fire sale. It's not that. Where is it? Oh, I know it's here somewhere. Let's see. No, 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 no. Well, that's that one. I know that's there, but not that one. Where did he post that? Hold on a second. See if I can find it down here. Here it is. Yeah, that's the link to it. If you're a TRG member, you'll see that there. So I'll just post it. Anyway, that's what I'm talking about. Chart to Dome 2.0 is one of those. And so I'm going to talk a little bit to that today, kind of try to do a summary version of that. And I'm going to go ahead and get started because people might drift in, but I don't want you guys were here on time. I don't want to penalize you for that. So the whole concept here is pretty simple. Most people come into the markets and they start with some sort of chart orientation, like, here's a 30-second wave volume chart. And I've explained before, Surfer Dude, one of my students and friends, he uses 15-second wave volume and nothing else. And you say, well, why 15-second versus 30-second? And that kind of takes us immediately to point number one. There's no correct interval for anything. All time frames are wrong. You say, well, my friend trades really profitably on the 5 minute. Well, good for him. That doesn't mean you will trade profitably on the 5 minute. And it doesn't mean there's anything special about the 5 minute. It just means that there's some sort of pattern that he's seeing on that. And it may or may not be coincidence. There may be ways to quote unquote back test it, which is usually nonsense because, again, you can kind of data fit to the question you're asking. So the point is anything that works left to right with some sort of interval. And again, it doesn't matter if that interval is time or it's ticks or it's range or whatever. Anytime you take the behavior of a market that trades either in upticks or downticks and put it on anything like this, you're creating a model of it, and it's important to understand that anytime you create a model, that literally is all you've done. There's really no difference between that model and this model. This is a 30-minute footprint. This is a 30-second wave volume. One isn't better than the other. They're just representing the same thing differently, but they're both models. This one's a little more accurate. The this one that I'm jiggling, which is the well, it's a couple things. It's a volume profile and then it's footprint charts, and a volume profile. Why is that more accurate? Well, what it's showing is what's occurring at every price, literally. And what you're seeing here is showing kind of a summary of that. So if you were to take and make a hierarchy of, well, what's the most accurate? Well, probably the most accurate way you could look at the market altogether is to look at the Globex session footprint, which I can't really fit on the screen because I have it on a vertical monitor. But basically, where one bar is the entire session. And then every price this session's traded, you could see there. And then this one, the next one down is 30-minute. And again, the intervals are arbitrary. 30-minute is used in market profile. There's a lot of traders that trade around market profile, so it can be very instructive. Like right now, there's price rejector patterns at the top of every rotation and the pullback of that rotation. So that's a very informative thing. And the reason it's informative is because that's telling us what's happening at a specific price level and how it's happening. In this case, a price rejector is a combination of a lack of, in this case, buyers. At the bottom, it would be the other way around. A lack of buyers. So we're running out of buyers. We're exhausting buyers. And of the buyers that are here, the sellers are absorbing them all. Every buyer, they're saying, yep, I'll sell you one. That forms this pattern, which we call a price rejector. And that's a very reliable pattern to trade off of. You can't see that very easily on any kind of left to right plot. You could take plots off of a footprint and put them on here, but you're missing the point if you're doing that. What a wave volume chart does is it shows you over time how we react to a price area. And then when we leave it, this is where wave volume is the most valuable. We had a very clear ebb and flow range going back here, and I'm going to draw on this real quick to illustrate this example. So price actions can either be high momentum, which this was, we went up, or it can be a high volume reversal, which there isn't. Well, there's one right there where we were coming down real high volume, and then we turn around and now we're going up real high volume. Often it then goes into an ebb and flow pattern like this, where equal amounts of volume going either direction and it's not really changing the price. But what you want to pay attention to is when it's leaving that area one way or the other. That's what's really important. So here, let me erase this one and put that back. See what's happening. This was the recent high. This was a recent high. Look what happened right there. That's called a spring in Wyckoff technology, or terminology, I should say, where a recent high or low, when it gets exceeded, really shows an aggressive move. In other words, we kind of formed a channel here, and that will not change it to one side or the other. In other words, buyers or sellers gets more aggressive at the edges of this channel, and that's exactly what happened. And so the buyers that took us up from down here to this channel, either they rested for a bit or they went away and new ones came in or whatever. But once we established that range, we left that range very decisively. Okay, the same thing happens in much smaller time frames. Remember, we're looking at 30 seconds, but there was a bunch of that happened right in here. And if you look at how much time this is, it's hard to read this down there, but that says 10:20 on my time, and this says 10:40. So this entire thing represents about 20 minutes. So you can say, well, there was a trend down there. Yeah, but there was lots of little moves within there that could have been very important. And so this is a really common mistake that new traders make, and particularly if they come from technical analysis. Technical analysis always tells you that the further out you go, if you look at the longer term time frame, it's more accurate. And from a mathematics point of view, that's exactly wrong. the less data points you have, the more accurate it's going to be over a few of them. Whereas if I have tens of thousands of data points, like I might have on something like this, any short-term move is statistically irrelevant. But if I'm looking at this on a much faster time frame, I can game that. I can say, well, if it goes above that area there, then I know I'm wrong. And if it goes below there, it's probably going to do one of those big high volume breaks away. So where am I going with all of this? I see a question or a comment. I'll get to it in just a second. I made that one was 30 seconds. This is 3 seconds. Which one of those is easier to understand the answer to this question? Remember, I showed you guys this in previous sessions many times. This question right here. Remember, this is all the stuff I use to make a decision. So time of day, we're going into the close, and there's some very cool patterns like short squeezes at the close of the day. So we already know where we are there. Number two, direction. Which way are we going right now? So is this view easier to answer that question, or is this view easier to answer that question? Yeah, RFN is the 3 second one. Look at this. You look at this and say, well, this is noise. We're just going back and forth. And if you look at the volume, well, it's a little more aggressive on the downside right now. And that's why this is all painted red. These numbers are bigger than these numbers up here. But let's go look at this on 3 seconds. There's a really good trade setup right there. That was a high volume reversal. That occurred at 10, hold on, I can look at the 10:56 on this time frame. Where was that here? Okay, 10:56. Okay, that setup occurred. Gosh, it's hard to even find that spot. Okay, that was right in here. So there's setups going on within these bars, and if you get too zoomed in on it or zoomed out on it, you'll miss them. So it's often useful to compare them, and this also gets me to my next point, which I'll make in some detail in a second. I just want to define it, which is if you can learn to focus on what's happening right now over here on the dome, the vertical version of what's happening right now, basically what you're doing is you're moving yourself a degree of expertise beyond left to right, because both of these patterns will be evident over here if you know what you're looking for, particularly if that particular price area is one we've been in for a while. Like we've been in this one for a really long time. I bet there's a lot of volume between 45 and I'll call it 12. Let's see. Okay. Here's 45 right here. That just happens to be the top of the value area. And where's 12? That's down here. That just happens to be the bottom of the recent range. So that makes total sense. That's a big high volume node. Oh, and guess what? Where are the high volume and low volume nodes? That's another thing that's important on this list. And that's an easy way to see them. So again, if you get away from the idea of time frame and understand it's really just the vertical, and learning how to break it into pieces can be really useful. But you don't need a chart to do that if you learn how to read it and learn what you're looking for on the very fastest time frames, and then learn how to convert that to what it would look like over here. You ultimately don't need this part at all, but there are some useful pieces to having it, particularly a very fast one like we're seeing right here. I made the NQ ones this kind of lighter color, and the ES ones are the darker color right now. You can see we've got pretty good aggression down on all time frames. So, the technical analysis people would say, join that momentum. And guess what? In the futures world, that's the worst place to join it, because that's exactly where it turns, and it just did really aggressively. So that's a perfect example of why I'm showing you this. That's my point. If you trade futures thinking that, you're going to be late and early every time. You're going to be late to quote unquote trends because there aren't any. It's about direction in the very short term. And you have to learn to understand where it's likely to turn. This time we turned right on a common inflection point, which was 90 to 0 in NQ. And now we're trading back above zero at about 10. And I've told you over and over again, if zero holds, it might overshoot by 5 or 6 or 8 points, but it's probably going to bounce off of there and revisit 10 to 20. And it got as high as 12 so far. So these are patterns that repeat a lot. And if you get too caught up in watching what happened up to that point, you're going to be, oh, I'm going to get short. Look at all this momentum. And then boom, that's exactly when it's going to turn on you because they know how to suck people in like that. Remember in the previous sessions what I said about the different traders that there are in the futures market. There's people hedging equities funds and they couldn't care less what we're doing. And they own 500 stocks and they're hedging it with a 500 stock futures position short. That has nothing to do with us, but occasionally you'll see a lot of volume because they're the biggest in this market. But they don't trade anything like what we do. There's no support, resistance, none of that nonsense. Okay. The biggest group in our market are aggressive hedge funds, and they love to push boundaries where they think they're going to find us, like at the edges of momentum. We just saw that. So, good example there of how that looking at any time frame is going to be wrong if you're looking too far in the past. So, let's see. Let me see what the comment is, and then I'll go into this in some more depth. When I mention the Globex session, do I mean the whole trading day or RTH only? Oh yeah, and that just happened to be right at the turn at the bottom of the hour, exactly. Which is typically, remember, there's a lot of market profile traders, and they're watching the 30-minute. And look at this, they got stops perfectly down there. Zeros at two levels, that stops. And remember, it's been price rejectors selling all the way down. They got all those guys sucked in to be short, and then they ran the stops and they reversed it on it. Very common behavior. And again, you can see that coming if you learn not to define what's happening by a time frame, but what's happening right now. And on the depth and market plots over here, it's really obvious. So I want to explain a little bit more there. Let me answer the question. The Globex session is 24 hours. So it's from when we reopen, and it's based in Chicago. So technically 5 p.m. Central Time. I'm 2 hours earlier than that, or Eastern Time's an hour later than that. So that's the opening of Globex. So it's after the session, the regular trading hours close, and then the settlement of the futures. Then there's a break, and then the futures open. That's the opening of Globex. And then the Globex session goes all the way through what we call regular trading hours, which is when the New York exchange is open. And that's from 6:30 my time or 9:30 Eastern to 1 my time or 4 Eastern. And that's what we're going to see, the close of regular trading hours. But the futures keep trading for a while into a period called settlement. And, depending on your broker or your evaluator firm, they may or may not let you trade in that time, or margins may change. But in a cash account, that you can trade that, and that's the time frame I'm referring to. So when I say Globex, I'm talking about the reopen to the 24-hour close, which would be in my neck of the woods 3 p.m. So it's going to be 2 p.m. rather. I'm sorry. So it's going to be 1 p.m. the equities are going to close, 2 p.m. the future is going to close, and they're in settlement through there. So I answered that question, hopefully. Okay, so let's go back to the kind of mini chart to dome. So I did a class a couple of times. There's actually two different versions of it in the library. One, they're premium classes. I did one a couple in the last year and a half or so, and then one a couple of years before that. And the idea was how you get from trading left to right, like you're seeing on the charts, to the dome, which is, in this case, I use Jigsaw, and it's not just dome, which is the depth of the market, but it's depth of the market and sales. And so that's the first thing to understand about what we're looking at. I'm going to clear the most recent plots of sales on both of these, and then Okay, so this is the price here. This is the people advertising they're going to buy. That's buy orders in the book on the bid. These are sell orders in the book on the ask or the offer. That's a cluster of liquidity there and there. And that's what I'm plotting over here on this. The whiter it is, the more liquidity there is around that area. Now, this is an important example. You can see since I reset this, it's plotting numbers on here. That's actual traded volume. That's trades that have actually happened. Whereas these are what people say they're going to do. This is what they've already done. And then this column over here, this column over here, and this column over here are kind of three versions of the same thing. This is all of the trades since the session started, the regular trading hour session. I do reset the domes at the beginning of regular trading hours because that's when the volume picks up. And again, that's the opening of the New York Stock Exchange. That's regular trading. So this one represents the bid and the ask volume for the whole session since I reset it at the regular trading open. This is just the delta of it. In other words, what's the difference between these two numbers? So at the very bottom, that should be mostly red because that would indicate it was trading on the bid. In other words, it was getting bought, and that's the case. Even though it was on both sides, it was predominantly on the bid. And likewise, it should be the other way around up here. It should be predominantly on the ask because again, even though there are buyers up here, the sellers should be overwhelming them and absorbing them, and they did. That's why that number is so much bigger than that number, and that shows me the difference of it. So that's what this is. And then to the right of it, there's the previous day. And today that's not really relevant because it's way down here, but like that's yesterday's high and yesterday's high of the value area. So that's what I'm looking at here. And the highlight color is the value area, the blue bar right there that moves around, as does the value area. That's the VWAP. So let me just put this into simple forms of English, and you can see why having any sort of chart is really duplication of information you should be able to see here. Oh, and one other thing, the columns on either side of the bids or the asks, that's the change. The one I've got highlighted here in yellow, that's how it's changing. That's stacking and pulling at that particular level. Are they adding to the bid or are they subtracting from the bid? And this time of day, you'll see a very strong bid create short squeezes. And the change in the ask, this will be negative and this will be very positive. So that'll push it up because people selling will see that and they'll pull out their orders to sell and they'll place them higher up. So the book up here will fill up while that's happening. So I reset those things every now and then just to see a summary of what's happening instead of having to watch it and discern the difference. This column's kind of unique. Every time we touch a price, it will reset the numbers. You'll see that if I don't reset it manually. So that can be very useful. That's called the current trade. So when we go back up, it will start over counting. You can see it just did it right there. It just did it right there. That can be useful to see a pattern in the very short term. Guess what? The pattern of where those little high volume nodes are right here and right here, those are exactly the same as what we're seeing, the little bursts of volume here and here and here. Now here you can say, well, I can see them pushing it up. Well, if I don't erase that, you can see it right here too. See, we keep trading into the ask with a lot of volume, but we don't go back down. So in English, buyers keep pushing up to where there's a lot of sellers, overwhelming those sellers. And so those sellers either get used up or they jump out of the way and the buyers push the price even higher. And if somebody's trying to sell, they can jump in on the buy side there and help join that momentum because maybe they want to sell all the way up here. That's how they get short squeezes going. And that's happening right now. So this is what I mean by what's happening right fracking now. This is all that matters in the futures market or in any market. But because if you're trading in stocks, you're trading on multiple exchanges. There's no stocks that trade on only one exchange, or very few anyway. And so a lot of them trade off the exchange altogether. So you never know if you're trading, say QQQ or SPY or anything like that, what all the buyers and sellers are and where they're buying and selling. You can't see that. In the futures market, you can see that. This is the entire market. Futures don't trade off the exchange. There's no such thing as that. And so that makes this information extremely reliable. And that's why we do what we do. So what you want to do is you want to kind of use charts with either wave volume on very fast time frames, and I explain why fast is better than slow. Or the worst case, look at a footprint of the session, which is great for context, or 30-minute intervals, which is great for market profile. And as you can see, I still do that. It's on my other monitors. I just don't make trading decisions off of that. I make trading decisions off of the depth and sales here. And I like to watch the wave volume because it keeps me from making mistakes. It helps me understand that even though a pullback might look really aggressive in the short term on the dome, this would look really aggressive. These are 3-second bars. So that's 1, 2, 3, 4, 5, 6, 7, 8. This is like 30 seconds of aggression. So that would look pretty aggressive here. And guess what? That is how you would get from like here, or this one is this. That's how you got from like here up at 40 back down to here at 38 and a half. That's this in here. So if you learn how to read this little pattern, you can get away from watching there. And that's, if you really want to be a high volume, high dollar trader, that's what you've got to do. And that's what Video Game Guy does over here in NQ. He watches the liquidity, and you can see it's gray here where the big chunks of liquidity are. And this is tick by tick. This is crunched together 4 ticks at a time, so I can see more information. He looks for places where those guys are playing. Like right now, there's a little bit of selling here. We can see it, kind of that pattern here. So, maybe you'd sell right there and see if those sellers are real. Now, on a Friday afternoon, that's probably not a great idea. Normally, you want to be on the buy side, not the sell side. Well, where is that? Well, right now, it's down here where the liquidity kind of is stacking up down here, just below, just around 10 and down from there. So this is one way you can learn how to figure out, well, which side's going to be easier to trade? Well, from here, it's the same distance both ways. So let's see what happens. And this is kind of what I refer to as a market maker approach of trading. You don't really care which way it's going to go. You're going to trade with whichever way is easier. So we got filled there long. Let's see how hard it is to make money with that. It should bounce pretty much right away. Let's see if we can catch a quick 5 points here. And let's see if this one fills. That did. Okay. So at this moment, we should see buyers pretty soon because they should defend that area. And here they go. So now we can kill that target, kill that, maybe get underneath it. So now I've got a defendable long. Why did I go long? I went long because it was the easiest way. It got filled first. There's nothing more to it. So that's what I'm watching on these very fast charts. And again, this is ES kind of in the darker color right now. And this is NQ in the lighter color. And even if you're trading MNQ, which is what I'm doing over here, you want to watch the data for the bigger instrument because it's going to be much more accurate for what you're doing. And the other thing that's interesting to watch when you're watching it like this, and I'll take questions or comments in just a second, is so this entire 3-second chart covers, it's a little hard to see it here, but that time frame right below us, let me scoot it down a bit. Okay, so this is 212 right here, and this is 210. So let's call the bottom of the chart 212, okay? And so 212 is right here on this chart. So this little burst of bars is this entire chart. So all we're seeing is where my mouse is circling right now. And see the wicks on the top of that? That keeps getting sold. And if you look at the volume here, you can see that. It's going down more aggressively in here than it was going up. So this is kind of telling us what's happening within that. And what you want to look for is those inflection points in this pattern will often help you see spots you could go to on that pattern. And if you can learn to read that, you can see it on the dome much clearer, and you don't need either of these. Or you can just pick one to kind of keep you dialed in, which is what I do. And that's what you've seen on my other view. I'll just run one of these, and depending on the conditions and depending on what instrument's trading, it might be something fast or short. I vary the time frames a lot. And then I usually have the TPO view next to it to kind of put it into context. That's what this is. And that's usually on the same screen because that shows me, well, here's what's happened the whole regular trading session, and here's what's happened overnight. So this movement that's happening right now, I can kind of understand how it fits into the rest of the last 24 hours and the previous few days. But again, if you learn how to read that vertically, this is today, this down here is yesterday. So I'm looking at more than 24 hours here. And anything significant is going to happen within those time frames. If I have to go back to seeing, well, last Monday it was support, I'll see that on the dome because if there's going to be support there, we'll see buyers and sellers congregating there, like you see this liquidity here or this liquidity here. So the fewer things you have in your face, the easier it is to make decisions. And I recommend going with as fast an interval as you can. So, for example, with this little thing we've got right now, I'm going to scoot that one over there just to show as an experiment. So these are the 30-second ones. I just moved them onto another monitor, and I'm just going to stretch this out. So this is 3 seconds. You should practice on something like this, and then ultimately you don't need a chart at all, or you can just use the chart to see relative inflection points. So right now, in both cases, I'm going to reset the current volume. You can see it inflected right on liquidity here in ES, which it likes to do. NQ likes to overshoot liquidity, and liquidity moves around a lot. So that's true there, but it's harder to learn the patterns. They occur at certain blocks of price levels, as I've explained. So right now I'm going to reset all the current volume, all the stuff that just happened. We'll leave the session volume up. Now let's look at the top one, NQ. Which way are we going right now? We're going down. How aggressively? Not very. So, okay, let's look at ES. Same thing. We're going down, not very aggressively. And we've been here recently before in both cases. So this could be a spot. If the market's going to be really quiet, this could be a spot to scalp in ES for ticks. Because if we're not moving much, you can do that with some size and you're not taking a lot of risk because you kind of know the boundaries of the short-term range really clearly. Right now, below 40 and above 37.5, which is the quarter number down here at the low, that's a perfect scalping range in ES. Funny how that works. Remember, I've explained the quarter numbers a bunch of times. Now it's going to go up. On a Friday, it's probably going to go through 40. So 40 is right here. So again, you can see it over here also. So you should just learn to read this over here. So 40 is right there. There's a bunch of liquidity right there. So what we want to see is what happens when we get up into that liquidity. It will probably, if it's typical Friday, they'll probably try to push it up through there and create a short squeeze because a lot of people have any sort of short position have to get flat by the end of the day, and they've got 45 minutes or so of regular trading left to do that, or the settlement period, and they can often run stops there too. People will see that recent high, and you'll see an attempt sometimes to sell it or to buy it, and get people to sell it, and whoever wins, that's the direction you want to go. You don't want to try to predict which way and who's going to win. So this one was a really aggressive move up, and then it just got really aggressively moved down. So here we are. We're right there now. We're on that spot. Let's see what happens. Watch the traded volume. Watch the change in the book right here, the highlighted in yellow. Okay, so far they got a half a point above 40. There's sellers coming in. See, that's we're trading on the ask now. In other words, see right here. But can the buyers push it up a little bit and stop those guys out? In which case, we're probably going up 42.5, maybe 45, which is the next liquidity. On a Friday, that's typical. This is summarizing the book, which is stacking right now. 3 digits there. They're pulling it away from here and adding it here. That's why price is going up. People are raising prices. You see the pattern? So there's an inflection point right here. So I don't need this chart to see that. I can see the battle going. And there we just rotated down, and we typically, even if we're going to keep going up, we'll rotate down by 3 or 4 ticks. We did that almost to the tick right there. Now, does it reassert up or does it start going down? If it starts going down, it's probably going to revisit this same quarter number near the low. And again, we don't need this to see it. Here comes 42.5. Again, on a Friday, you want to go with this energy. It's very common that there's short squeezes on Fridays. Okay, let me see what comments and questions we have. Nothing new. Okay. So that's pretty much the theory here. And we'll just watch the real fast one for a few minutes. We don't really need to watch either of them. But if you only watch a very fast view, like this 3 seconds, you'll almost never be wrong on choosing which direction to try to play. And right now it might be changing. It was long, but we got up to that 42 and a half quarter number, and we got up here to about 20. Remember, that's an inflection point often in NQ. We got right to it, and that's where the sellers came back in. So this wouldn't be a bad spot to reset the current volume. So I'll do that again on all those, and we'll leave the volume for the session, and we'll see what happens here. Are sellers taking control, or are the buyers going to be strong enough to push through the sellers here and create another short squeeze? The buyers would love to see that. And to be honest, so would the sellers, because they'll be able to sell for higher prices. So if they sense that behavior, they'll jump out of the way. They'll cancel their sell orders here and move them up because they know they can probably get higher prices in 3 or 4 seconds or 20 seconds. And they're not looking at a chart. They're just looking at the relative aggression in the book of buyers and sellers. And this is what the key point is here. Key point, key point, key point. As I said at the beginning, markets don't move left to right. So if you're looking at any sort of representation left to right, like these 2 3 second charts, it's going to be late and it's going to be a model of what happened. It isn't going to be what happened because prices can't go left to right. They either tick up or they tick down. In case of futures, they can trade at the same price, but that's still either the same uptick or it downticks from there or upticks from there. Again, trading at the same price isn't going sideways. It's the auction at that instant is balanced. Nobody's aggressive enough to make it leave that spot. And so those are really important spots. And if you watch the behavior of liquidity around them, that's how you can see what's happening. And so in both cases here, the bluer and ES and the pan NQ, you can see we're seeing aggressive selling down that's immediately finding buyers because again, people are probably covering into the close. And anytime there's any sort of aggression, even if it's by the people trying to cover, they can run stops either way. That's evident. So they're doing that. And the dominant behaviors to the upside though. And if you watch the spots that it typically inflects around, you can go with that pretty easily. And I just showed an example of that when we put up those trade parameters, both long and short, and the long trade filled first. And then it was a really easy, nice little long. Now, that doesn't mean that's going to continue. We've talked about closing setups, and there's a really good examples of them in the 10 micros in the close class that's currently on sale. I already posted that link. Often, particularly on a Friday, going into the close, there's short squeezes are very common for the reason I just explained. The other patterns that are very common on any close are big, strong reactions at the extremes. And again, this is a really good way to understand which way to play on those. And then tight range behaviors, which is what we're seeing now. And that's the one where people have the most trouble. This because they look at this and they say, well, it's just choppy. Yeah, it is not choppy. What it is this is value has been determined for the short term. But if we leave this area, as we've seen over and over again, it's going to do it really aggressively. It just did that. We were in another one of those choppies, and then boom, we blasted out of it. And where was the blast off? It was right as it took out the most recent high. This is the most 3 second high. It did the exact same thing down here, and it blasted off all the way from what? That was, oh boy, that was 93, and it went all the way up here to 26 on that move. So again, if you just learn to focus on that, focus on the energy of the short term, you can do really well, particularly if when it's really moving around a lot, you lean toward NQ because you'll make more money there if you can manage the trade, if it's giving you respectable, manageable ranges, which right now it is. And it has been on and off most of today. Today's been jerky, but predictably jerky. What do I mean by that? Well, if you take this and look at it, we gapped up. And we barely have revisited the gap. So the gap and go pattern held. Remember I said if it gapped more than 20 points in ES, you want to go with the long end of that gap. Well, sure enough, here's ES, and that was the top of the gap, and we're above that now, and we came off it really aggressively a few times. We haven't really been very extreme, but the VWAP's been coming up all day. So if the VWAP's coming up, extremes are less meaningful because if this number is going up, an extreme of that number needs to be higher up. These are standard deviations of that number. The VWAP, standard deviation 1, 2, 3, 4. Well, standard deviations, if you look at a bell-shaped curve, as long as the behavior is staying in the same price range, those are significant. But if it's trending or directionally one way or the other, those will tend to go that way also, like they did back here. So an extreme isn't as meaningful as long as the range is changing. If the range isn't changing, then you can rely on those extremes. And today the range has been meaningfully stable to the upside. That's why if we don't have a strong burst of volume up there, those extremes will be in play. If we do have a strong burst of volume going into the close, however, that'll often suck in traders shorting up there because they're not understanding that the high volume is going to make those extremes not really mean extreme anymore because the volume's going up. And it takes something like a standard deviation some time to understand that. You're doing a sum of squares, right? It's regression. Okay. Again, if you don't understand all that math, it doesn't really matter, but that's the technical explanation for why. And all you need to understand is why and how to trade it. That's why so many, people that were just high school graduates used to make a lot of money in the pits, millions of dollars, because if they were streetwise and they understood supply and demand, that's all it took. You could trade there. And now electronically, you need to understand how to read the tools. They used to do it in the pit with how loud people were screaming. And on this view, learn to read it vertically. So toward that end, what I'm going to do is I'm going to minimize both of these, and we're just going to watch the traded volume. Now, the other thing that's helpful here is the tick, which I have down there. This is the tick of the broader market. So that's more closely related to the S&P 500, which is what the ES is derived from. This is the advanced decline of the broader market. And then this is the same thing, the tick for the NASDAQ 100, which is what the NQ is directly derived from. The S&P 500 and the NYSE tick are a little different, but they work the same in the broader market. There is a tick for the S&P 500. I have tried it, and I actually find this more useful. Because the purpose of that is to see the broader market, because we don't really trade the broader market index. And so this is kind of a way of comparing what the futures, which are a derivative of the equities, are doing versus what the equities are doing. Because the equities can't be crashing while the futures are rallying. That's not possible. One or the other would have to come into line one way or the other. There'd be arbitrage. One groups would sell one and buy the other. And the reason that we sometimes have differences that are in the very short term, and that's why I like to watch short-term chart views. The reason that's important is because the futures tend to overshoot what the equities are doing, because the futures are a much more speculative instrument. So the speculators that are trading here are pushing the retail traders around that are trading here. That's what's typically happening. In equities, that happens too, but it happens in a very different way. So, okay, let's see. No questions or comments. All right, so let's just watch and see, just looking at this. So we're just looking at the vertical here. If we can find any decent trades. Well, what's happening right now? Let's center everything. We're just above the VWAP, which is that blue line again. There's liquidity down right around there, and it's kind of not real aggressive. There's a little bit that's kind of coming and going as the price is going up and down. Those are probably liquidity providers, maybe some bigger scalpers. Same thing on the other end. So that's not that meaningful. I'm seeing pretty much the same thing over here in NQ. So this might not be a bad time to look for some trades in ES. So again, we've got no charts whatsoever. We're trading right below a quarter number of 40. Let's get long, just because on a Friday, that's a better direction than getting short. And then maybe scale that down to maybe the VWAP at the quarter numbers or around there. Maybe get one right here. So now I've got two. Why didn't that fill? It did. Okay. So And then the next quarter number up is 40. It'll probably trade there and then 42, 42 and a half. So we can maybe see if it gets up there and kind of see how we're doing on this long as it does. And here it comes. So I'll either try to protect this with a stop under it if I get more than about 4 ticks away, or I'll just take profits on it if it's going to reverse. And it will try to do that right here on this quarter number. I'm going to take one off there. So now I only have one left. And now if it rotates back down, I'll scale back into that. So I'm just watching the 3 and 4 tick rotation. And if I can't get back in below that in 3 ticks from where I just took profit, which is right there. Good. I got filled. Okay. That should be now it should rotate back up. And sure enough, it is. So I did that exactly right. And I made extra money on that. And now I have that contract again. I sold it and I bought it right back for 3 ticks cheaper. So that's how you can rotate in and out with the larger traders that are rotating in and out. So hopefully, let's let this scoot up a bit and then we'll get under it a little higher up. So now I'm locking in, trying to lock in 2 full points. I can do that right there. Okay, now I've got 2 points locked in on that one. So let's scoot the target up and see if that holds. If not, we'll try to buy it back a little lower down again, like right here. So basically sell it up here, buy it back for 3 or 4 ticks on sale if I can. I can't, it won't let me because everyone else is doing that. Okay, can we get a fill right here? It's trading there. We got fill perfectly. All right, so now again, we just did the same thing. We're rotating in and out of this and we're getting paid extra to do it every time it rotates back. This is kind of that advanced market maker approach that I've talked about. And this is a higher level of it than putting orders at every tick. This is just trading in and out of the rotations. If you're going to do it with minis, that's a better way to do it, what I just demonstrated, than trying to put lots of orders. Like I've shown the market maker approach, which is kind of put orders for lots of micros every tick and rotate in and out that way. And I'll try to demonstrate that now here if I can. So if you've got the range right, it shouldn't rotate too far away from you. So let's try to keep 2 of these. And then as it comes up here, I wouldn't short this till at least up here now. So that's the problem with the market maker approach is you're really either in or out. And I like to scale in and out. So right now we've got a nice move up. If we can add to this again, like right there, I would do that because see that we scooted through that area and the inflection points are really clear right around the quarter numbers. So you know what? Let's just buy another one at the market here. Maybe we can fill this on a sweep down. It almost filled on that sweep down. I'm going to reset the short-term volume again so I can see where it's trading clearly. So now I've got 3. I bought one more there because this wasn't filling. And sure enough, we're scooting up higher now. So I'm reading it right. Let's get another stop under this now if we can. No, you know what? Let's try to buy it. Let's not try to sell it. I was going to say maybe I'll jump out of one here. Okay. Now we've got 4. Now the next quarter number up is 42 and a half, which is right there. So that wouldn't be a bad spot to take a little off. And you can see that's where on this push up where it gets sold right there. But the buyers the sellers were not very aggressive there. So we should get filled here fairly easily. And so again, I just bought those on sale, only this time it was a 5 tick sale, see? And so you can just keep doing that and building up your profit. This is a version of the always in drill, Chris. And it's a really good way to learn how to do that. And notice how this is my profit just keeps going up as I'm doing this, but some of that's already in the book. So that's kind of nice. And I can always just protect it all if I want and just let it go, which would be, so there's 3 stops. Let's see if that gets hit. If it does, we could always buy it back lower down. But I'm locking in a couple of ticks on the entire trade there. And it's getting a little bumpy here. So there we go. Are we on no, we're just passing the bottom of the hour. So this is good. Let's try to ride that up and we'll kill these targets up here. Because notice how the liquidity kind of moved up. Now it's kind of up here. So I should have scooted that up earlier because I could have gotten filled higher. And now I might get hit on the way down. It's rotating down. Yeah, that's going to happen. So I should have pushed that up instead of canceling those. I was kind of in the wrong sequence there. But all right, now this spot's probably back in play around 40 because we're on 42, but I think we're still going up. So you might want to front run that a bit. See how the liquidity is stacking up here? It's net stacking, which is why this is blue when it's blue. And if it's net increasing on this side, it will be on the red down here. That's summarizing the stacking and pulling for me. So this is still a long trade. The problem is, from where? If you get too aggressive in the wrong spot, it's going to rotate back on you and they're going to, stop you out. And that's going to be actually a really good spot to scale into that particular area, not to scale out of it. And so let's keep watching that. The last place it got aggressively bought was right here. See, right above that, because that was sellers getting absorbed right there. And then we got above that and we got this low volume area. So remember what's on the document, high volume and low volume nodes. We go through low volume nodes quickly and we did up there. Oh, look, we filled on one of those. Okay, cool. Let's try to get a few more down here. It should hold this area if we're going to continue Friday's strength. There we go. We're going up again. Let's get another one at the market. By the way, notice how we have no chart here. I'm not watching the chart at all. I'm just watching what's happening right here. I'm paying attention to the tick, which is fine. It's flat, roughly. And, this is the broad market, which is still more or less up if you look at the advanced decline. So, all right, here's a 3 lot again. Maybe let's protect one of those. And that's going to let it bounce back into here, and we'll take it off up here instead. That'll be easier to do that. Okay. Now we've got 2 again. And, it's probably headed up there somewhere at least. But again, if we can rotate in and out of it here, that would be ideal. That way we could get some more size on. So this is what I refer to the market maker's approach. And then when it's just rolling back and forth 3 or 4 ticks, in this particular instrument, I recommend just getting aggressive on that. You can do that right here because it's on the 42.5 quarter number. And then if we get all the way down to 40, you should get a really good scale into the next long, as long as this behavior holds up. And again, on a Friday, this area is being bought pretty aggressively right here. If we had a chart, we could see that. Well, just for fun, let's bring the chart up and see what it would be telling us. So there's the 3-second view of ES. And see, so far, it's making higher highs and we're in a little ebb and flow. We know that and we're long. So below about 40 is where it might get scary, but it could go all the way down to 39 before it would really get scary on that particular time frame. And then let's look at the other time frame, which was 30 seconds, I think. Where did I put that one? Here we go. Here's 30 seconds. And you can see, what's that look like? Let's regenerate that. Okay, same thing. We just made a higher high, we made a higher low. This was our high volume reversal. So great. Those aren't telling me anything I didn't already know. Okay, we're definitely on an inflection point. Now I have 6. I should probably take some profit up here. Let's try to get a couple off as it gets back above 43, 43 and a quarter. And then maybe we'll have 4 or 5 for a runner. I see a comment. Yeah, it is. But that's why you should always, one of the things I used to do, and this was something I always did, I always used to teach people to do, and I recommend it, is spend 5 minutes looking at the market before you ever trade. Anytime, you go to the bathroom, you go get something to eat. When you get back, spend 5 minutes just staring at this as if you were trading it to get yourself synced in. Or if you're trading NQ, you want to be watching 0 and 20 and 50 and 70 to 80. And how is it behaving around those? And how's the liquidity moving around those? That's what's going on in NQ. That's how you read it. So let's see, we still have 6 over here. Let's see if we can get a few more. Now we have 7. Okay, we'll try to take 2 of those off going up. You can see there's liquidity right there at 43 and a quarter. You can see that white line. That's this liquidity being represented. Let's see if it rotates up off of 40. I'm going to end up with maybe 10 down to 40, maybe a few more than that. These are micros again. I'm going to put sell orders up there as I get more. That way I don't end up with a much bigger position than I wanted, as long as I'm reading the rotation right. But it could go all the way down to the VWAP, and I'm still reading this right. So that's why that question, where are you wrong, is important. On this particular trade, I'm willing to scale this quite a bit on the long side. So I'm wrong if, we start selling really hard below the VWAP, and that's a long way down. But all this liquidity would have to get run over first. So I'm willing to scale into it a little bit here because the relative risk of doing that, particularly on a Friday with short squeeze conditions, is low. It's likely to go up on rotations. It might rotate farther down than I expected, but it's still likely to go up. That's the statistic I'm playing on Fridays. Here we go. Now we're trading for 42 again, and I was just buying 39. Excuse me. I'm boiping. Somebody needs to come burp the baby here. I drank a bunch of coffee a while ago, and that always makes me burp for a few hours. So I apologize. Okay, see, I'm letting it try to come get me here because the worst case is I get some really good fills and the liquidity holds. And if it goes a lot further down, I can just jump out of the way. This doesn't represent a large position yet. Still only 7, now 6. And each time, again, this was a brand new trade. I'm improving my profit into it. We took profit on the last one, remember, and we're starting over. So I want to just keep improving the profit number and scaling in on the way down and out on the way up, but keeping a decent little, couple of contracts, whether in this case they're micros. If you do it with minis, just add a 0. I'm just demonstrating it. So I'm not really concerned with, how much money it is, but it's fun to make a little bit doing this. I can usually do this and make, $1,000 during one of these classes if I stay focused on just what I'm trying to show. If I was trading it myself, I might trade it more aggressively, maybe 5 times as many micros, doing blocks of 5 instead of blocks of 1. I'm going to buy this right here. So I might get a little more aggressive here if it justifies it. I've got 16 now. So again, I want to start taking them off quickly because I'm purposely getting too many down here. And then if it goes a lot lower, again, that's the where am I wrong. But for now, where am I wrong is down here. So I'm going to give this one quite a bit of room. But you shouldn't necessarily give this setup as much room as I'm giving it. I'm doing this to demonstrate something. I hope everyone's clear about that. By the way, there's still unfinished business up at the top of this range. Fridays tend to be short squeeze days, particularly on days when the cumulative delta is negative. If you feel more comfortable with the training wheels, we can put them back up and watch those too. So here's 5-second ES, or 3-second rather. And you know what? Let's just use one of them and we'll just make a 5-second here and see how that looks. But again, see how the time frame doesn't matter. I'm not feeling very well, guys. I don't know why it is, but I'm getting a little nauseous, so I may have to take a break. That's been kind of going on and off for a couple of days. That's why one of the reasons I didn't do anything yesterday. So I'm just going to sit down for a minute. I'm away from my computer, so I can't grab my mouse if something happens. I'm sitting away across the room. So let's see if this trade works. I'm just going to have confidence in my read. Particularly, I'll be more confident the higher the tick goes right now. See, it's just trying to go positive. And, short squeeze, it might be at plus 500 or so. And most of those sell orders will fill like they're doing now. So you see how easy that is? You don't have to be at your computer. We're up a couple $100 here on this. Let's take a few more off. Get underneath it with a few. What do I have? 10 left. Let's cancel everything and we'll just put cells under it. And see, if you don't take the profits, you end up giving a lot of it back, which is why you should take profits quickly. So again, I'll let it come up here. When I have 8 left, we'll let it start taking profit on this rotation. I'm going to have to wrap this up. I'm feeling a little nauseous, guys. Probably, like I said, I've been fighting a bug. Let's see, what do we have left here? 4. Let's protect those 4, and then we'll see if we can let this rip. I'm going to wrap this up in just a few minutes. So if you have any questions or comments, please let me have them. Otherwise, I'm going to end the session. I'm I'm in need of doing what an old man would do and lying down for a few minutes. Okay, we just got flat. Robert, let's see. You entered right before the price where buyers got aggressive earlier, not where sellers got absorbed. He has a little bit of both. I sometimes front run it because I can see it coming. Will this recording be available to guests? If you remind me to post it somewhere, yes. It'll automatically get put in the TRG library, but it won't be available to guests unless you could tell you what, send a message to JVC. He's the one who does that, and tell him I said it was okay. I'm sure he'll agree. Chris, please ask him to put it out on YouTube, which is then it's available to the whole world. Okay, and cool. I appreciate you doing that. That'll save me having to do it. Okay, so I'm going to bring the charts we hit a while ago back up, and while I'm doing that, if you have any other questions, by all means, let me have them. I'm just going to put these back to 5 seconds and default colors and okay, there we go. 5 seconds, 5 seconds. That works. And let me close the other ones. Let's see. ES 30 seconds. We don't need that. And Q. And Q. Where did I put that over here? And Q 30 seconds. Don't need that. Okay. I'll get to the questions and comments. I see some stuff coming up over there. I'm a little too far away to read it right now. Give me a moment. I'm at my other monitor. Okay, cool. All right, let's see, Robert. I already answered that one. Yeah, anytime they start in earnest around 11:30 my time, Bob. So about an hour and a half. Well, yeah, about an hour and a half before regular trading hours is when and then depending on what's going on, they can be aggressive for an hour and a half. You can see short squeeze after short squeeze after short squeeze, and then other times, they might only occur in the last 10 minutes of the day. So I've talked about them in the 10 minutes and a close class. If you didn't take that, it's on sale right now. That's a good spot to look for that because I explained the parameters of that setup. There's a couple of other things to look for, but in general, that's the base, the most important stuff. You want to see that relentless bid coming, and sometimes I'll see it coming before it does. And because I'm used to the pattern of rotation around 3 or 4 ticks. So often I will trade the rotation before the short squeeze starts, and then the short squeeze will start after the rotation. So I get on the rotation, and then the benefit of my rotation trade benefits from the short squeeze starting. That we saw that happen. After 12:45, yeah, often they occur right at the top of regular trading hours. Right when we're ending, because futures traders will cover as late as they can if they think they can get better prices. So a lot of times you'll see last minute pushes down, particularly on days we've been down a real lot, Bob. You'll see when we push down really hard that they'll get really aggressively bought, and that's where short squeeze will start because all the people that are still short pushed it down and they fed that, and then they're like, okay, cool, we can now cover at lower prices, which is what they want to do. That's why squeezes start because they're all trying to cover. And like today, the net is probably still a decent short here. See the cumulative delta is still pretty negative. So, but today on a Friday, if it doesn't occur by now, it usually occurs after RTH close while it's in, settlement. And depending on whether you're trading in a broker account or an eval, you may not be able to trade at that time, or your margins might be different. In a cash account, they would be probably. All right, I gotta sit down here, guys. My head's really not holding together. I apologize, but Anyway, I covered the material I wanted to. Are there any other questions or comments? I appreciate y'all coming. It was fun. I hope you learned something. That's my mission. Okay, I'll see y'all later. You're welcome, Robert.